A single Fed move could cost you $4,200 annually. The Fed's recent minutes show a deep divide on interest rates, and we're breaking down what this means for your finances, including potential increases in borrowing costs. The implications are far-reaching, affecting everything from mortgage rates to credit card rates, and even the broader economy. For instance, the U.S. economy has seen significant fluctuations in the past, such as the 2008 financial crisis, and understanding the current interest rate landscape can help you navigate these changes. Additionally, the impact of interest rate hikes can be felt across various industries, from housing to consumer goods, making it essential to stay informed and adapt your financial strategy accordingly. And the recent Fed move could lead to higher mortgage rates, with a 6% interest rate on a $300,000 mortgage resulting in monthly payments of $1,800, up from $1,600 at 5%. But this is not just a US issue, as the UK has also seen similar trends, with a £200,000 mortgage at 4% interest resulting in monthly payments of £955. So, what does this mean for the average homeowner? For instance, in cities like New York or London, where housing prices are already high, an increase in mortgage rates could lead to a significant increase in monthly payments, potentially pricing out many buyers. And historically, we've seen that even a 1% increase in mortgage rates can lead to a 10% decrease in home sales. Back in 2008, when mortgage rates were around 6%, the housing market experienced a significant downturn, with many homeowners struggling to make their monthly payments. But the impact doesn't stop there, as higher mortgage rates can also lead to a decrease in home renovations and other related activities, ultimately affecting the broader economy. For example, Home Depot and Lowe's, two major home improvement retailers, saw their sales decline during the 2008 housing crisis. So, the next section will explore how this affects credit card rates. But higher interest rates also mean higher credit card rates, with the average credit card APR increasing from 18% to 20%, resulting in an additional $100 in interest per year on a $2,000 balance. And this is not just a minor issue, as credit card debt in the US alone totals over $1 trillion. So, what can you do to mitigate this? For example, you could consider transferring your balance to a lower interest credit card or consolidating your debt into a personal loan with a lower interest rate. But the impact of higher credit card rates goes beyond just the individual, as it can also affect the broader economy, particularly in industries that rely heavily on consumer spending. A notable example is the retail industry, where higher credit card rates could lead to reduced consumer spending, ultimately affecting the bottom line of companies like Walmart or Target. In fact, during the 2008 financial crisis, many retailers saw a significant decline in sales, which was partly attributed to the increase in credit card rates. Furthermore, a common misconception is that credit card rates only affect individuals with poor credit, but in reality, even those with good credit can be affected by higher interest rates. For instance, a study by creditcards.com found that nearly 60% of credit card holders with good credit have seen an increase in their interest rates over the past year. And the next section will delve into how this affects other loan rates, including personal loans and student loans. But the part that surprised me most is what this does to your 401k and how you can protect yourself from the potential downer. For instance, did you know that the average 401k balance has decreased by 10% in the past year alone? The next section will reveal the shocking truth about how the Fed's interest rate decision can impact your retirement savings and what you can do to safeguard your financial future. Specifically, we'll explore how to create a retirement plan that can withstand interest rate fluctuations and provide actionable steps to help you get started. And the increase in interest rates doesn't stop at mortgage and credit card rates, as other loan rates, such as personal loans and student loans, could also see significant increases. For instance, a $10,000 personal loan with a 10% interest rate could result in monthly payments of $115, up from $95 at 8%. So, what does this mean for the average borrower? For example, in the US, the total outstanding student loan debt is over $1.7 trillion, and an increase in interest rates could lead to a significant increase in monthly payments for many borrowers. But there are steps you can take to mitigate this, such as refinancing your loans or consolidating them into a single loan with a lower interest rate. Additionally, some lenders, like SoFi or Lending Club, offer more competitive interest rates and flexible repayment terms, which can help borrowers navigate the changing interest rate landscape. Historically, we've seen that borrowers who refinance their loans during times of rising interest rates can save thousands of dollars in interest payments over the life of the loan. For example, a borrower who refinances a $20,000 student loan from 8% to 6% can save over $1,000 in interest payments per year. In the next section, we'll explore how you can respond to these changes. But here's the surprising way you can protect yourself from these rate hikes. And it's not just about cutting expenses or increasing income. The next section will reveal a powerful strategy that can help you build a financial safety net and even take advantage of the current interest rate environment to grow your wealth. Specifically, we'll explore how to create a diversified investment portfolio that can withstand interest rate fluctuations and provide actionable steps to help you get started. For example, did you know that some investors are using the current rate hike to their advantage by investing in high-yield savings accounts, or CDs? So, what can you do to protect yourself from these rate hikes? For example, you could consider paying off high-interest debt, such as credit card balances, as soon as possible. Or, you could look into refinancing your mortgage or other loans to take advantage of lower interest rates. But one often overlooked strategy is to build an emergency fund, which can help you weather any financial storms that may come your way. And historically, we've seen that having a solid emergency fund in place can make all the difference in times of economic uncertainty. For instance, during the 2008 financial crisis, those with a well-stocked emergency fund were able to ride out the downturn with minimal financial damage. Additionally, you could consider diversifying your investments to reduce your exposure to interest rate risk or exploring alternative investment options, such as real estate or precious metals. So, the key takeaway is to be proactive and take control of your finances, rather than waiting for the Fed to make its next move. By taking these steps, you can ensure that you're prepared for whatever the future holds, and even come out ahead in the long run. In conclusion, the recent Fed rate hike could have a significant impact on your finances, but by being informed and taking proactive steps, you can protect yourself from these changes. So, consider reviewing your budget and making adjustments as needed. One actionable step you can take right now is to call your lender and negotiate a lower interest rate on your existing loans. This simple step could save you thousands of dollars in interest payments over the life of the loan. Additionally, take a closer look at your investment portfolio and consider diversifying to reduce your exposure to interest rate risk. And if you're feeling overwhelmed, consider consulting with a financial advisor to get personalized advice. This is for education, not financial advice. Talk to a fiduciary for your situation. If this changed how you think about interest rates, hit subscribe. I break down one of these every week and provide exclusive insights and analysis to help you stay ahead of the curve.